All right, so last time we are looking at how to identify institutional structures because whatever you're going to do in chart analysis comes from the understanding of the market movement, where the market is heading to, where we're having a reversal, and we're still in a continuation state. So what we can see here now, this is the daily time frame, and this is basically Euro USD, and we can see this has been trending to the upside, and we can clearly see from this particular price delivery, we have price created this swing low point, but then we had a failure of movement to the upside to break this high to create a new higher high point. And what we can see is that price fell to the downside, taking out this low point, leading to a market structure shift. And in extension also, price is about to take out this strong low point that created this high point. So basically here we have a break of structure here. We have a valid break of structure because we can see volume closing above previous price swing points. So we have a break of structure there, and we can clearly see that price took out internal liquidity in the form of trend line liquidity. So we have the rate of the internal range liquidity. Price went for the external, took out the external liquidity. So basically what we have is that price gave us a high point here, which is a higher high, printed a higher low, price created this higher high points. Now we're expecting to see the pullback of price, and here we have the pullback of price to the downside, creating this low points. So basically these are all internal structures. They are not actually trying to tell us that the market has changed direction to a bearish movement. So all of these are just internal structures, because when you drop to a lower time frame, you're going to see bearish market movement within this pullback. So basically what I'm saying is, here we have what we have here is we have the impulse from this newly created higher low to this high point. That is the impulse. And what we have here is the corrective leg move. So when you drop to a lower time frame, basically this is going to be structures. Let's check the 4-hour time frame. You would clearly see that. So what we can see here from the 4-hour time frame, you can see basically within that price movement, we're having bearish structures. Now price gave us the pullback, but you can see that is why we said that the market is fragile. You would see structure in higher time frame. You also find structure in the lower time frame, because you can see now we have the fall to the downside. We have a market structure shift here, because this is the last swing low point that printed this high point. So we have market structure shift, fall to the downside, a pullback, price fell, broke this low, a pullback, price fell, broke this low. We had this deeper pullback to the upside, price fell again, broke this low. We have another pullback, price fell again, broke this low. So you can see that when you're using a time frame lower, you're going to find a lot of price delivery. So whenever you're confused in identifying structures, that is why you need to go to a time frame higher than the time frame where possibly you're having confusion in establishing the valid structure. So here we have the corrective leg move. So basically our expectation is to see how from this newly created low points, we're going to have an impulse movement to the upside that's going to take out this high points. Then we know we are continuing bullish. But what we can now see is that price here from this swing low points failed to take out this high. And then we had the price movement ending here. So this is just giving us a sign that we are failing to have higher prices, because prices failing to take out this high points. And then what we can see is the fall of price now to the downside. So we can see price failed to print a new high point, and then we have the pullback leg move back to the downside. And now what we can see is that the institutions took out this low point. This is a weak low point because it failed to take out this external range liquidity, and price broke through it. So we have what? The market structure shifts here. So this is where we begin to look out for the bearish movement, or if you don't want to take this as a market structure shift, then you can wait for price to break the strong points, which is basically this low. because this low sponsored the impulsive movement that broke this previous high point. So now we can still consider this as our market structure shifts, because already from the swing points, we already have a shift in the state of that delivery. We're already seeing that price is failing to create a new high point. And now we had the push of price to the downside that went further to break this swing low point. So we've established now that we're having the tendency of a reversal to the downside. And basically, I told you that when the market is moving, we're having bearish movements. Price will create this. For price to continue further bearish, price will seek this buy side liquidity. Basically, what the institutions do is just to keep seeking liquidities in the markets. So the institutions will seek the liquidity at the swing high, because they believe that buy stops, retail stop orders will be here, and then they would rate those orders, and then you would see they sponsor the bearish movement back to the downside. So the institutions will still create another manipulative movement and then sponsor a movement to the downside. Upon the return again, they would want to seek internal liquidity. And you can see this exists as relatively equal high points. They will seek those liquidities and then sponsor price again to the downside. So basically, we want to be looking at zones that will serve as inducement liquidities. So all of these zones are internal swing high points that are going to serve as inducement liquidity zones. Once the institutions take out the external range liquidity, they seek the internal range liquidity. That is what they basically aim for, because liquidity is what provide the movement in the market. So what we can see here is we have this market structure shift. Now we can clearly see the structure we are having. The fall of price to the downside, we had a pullback, another impulse to the downside, we had this pullback. Let me clearly identify those stuffs. So we had the fall here to the downside, this pullback, a fall, we had a pullback, we have this fall and a valid pullback, a fall here, a valid pullback. We continue further again to the downside. We had a fall here, we had a valid pullback, a fall here, a valid pullback, and then a fall here. So what you can clearly see from the chart is we have bearish structure within this movement to the downside. So what you can see is once price created this low point that broke the previous swing low points, creating the market structure shift, we can see where is the most recent high point that the institution printed. This is the most recent high point. So when we are having a bullish movement back to the upside, meaning this becomes the draw on liquidity. So the institutions want to seek this liquidity first, the buy side liquidity, before we have what the bearish continuation, since we've already established the market structure shift. And basically, you can see we have fair value gaps here. The movement of price to the upside had the probability or possibility of returning back into this fair value gap. But basically, the institutions will still move price just the way they want to. But we can see they respect this swing high points, this up close candle before this bearish impulsive movement. Because clearly what you can see also is that this swing high took out liquidity of this previous high point. This swing high point took out liquidity. So it's also a valid swing point to consider to take an entry from, because this has already seeked liquidity and then sponsored this bearish move. So now clearly what you can see is price returned to the upside, took out this liquidity. So basically this is trying to tell us that we have an established low point, and this is the established new low point, because what we can clearly see, we have this impulse to the downside. This is the swing high that gave us the impulse to the downside that led to the market structure shift, meaning it took out this external liquidity, created this low. So for us to validate this low point, then we want to see the movement to the upside that will seek an internal liquidity. And we can clearly see here that price seeked this internal liquidity, which is our inducement liquidity. So price took out the inducements, and what you can see now, we're having bearish impulse back to the downside. So for us to have a break of structure, we want to see price takes out this low point, and then we have a break of structure. Here we have the market structure shift. I told you that the market structure shift is basically what leads to reversal. So we can clearly see this is where we have the market structure shift, and now we're looking forward to see that price will take out this low points, giving us a break of structure to now establish strongly the bearish trend to the downside. So let's just play price to see how this unfold. All right, so you can see now we had the fall of price to the downside, and price took out this swing low points. So we have a break of structure there. So what validates the newly created high points is the fact that this high point now sponsored the bearish movement that took out this previous low points. So clearly you can see now we have a lower high point. So you can see we're establishing our structure now. So now we have price give us this low, we have the pullback. This is a valid low point because it seeked the internal liquidity, and now we have the fall to the downside leading to this break of structure. So now what we'll be looking at is where is the buy side liquidity. So basically you want to look at the internal structures. What we have is that we have this from this high to this low. This is the lowest candle. We had a pullback because this went against this candle and swept the high points. We had again this fall here to the downside, and then we can clearly see we had this pullback. Now we have this fall again to the downside, we have this pullback, and now we're seeing price again falling to the downside. Now we can find out that we've established the internal structure within this impulsive leg movements. So you can see we have this fall, we had the pullback, the fall, the pullback, the fall, the pullback. So this is the impulsive leg movement, and we can clearly identify the structure here. When we drop to the lower time frame, let's go to the 4-hour. You're going to see that clearly. So you can see we have structure within that. You can see that. So we have structures within that. And from the 4-hour time frame, you're going to see that we have more structure because it's going to be more clearer here. You have this fall, you had this pullback, the fall, this pullback, this fall, the pullback, the fall again, another pullback, a fall. So you can see why we said the market is fragile in nature. So back to the daily time frame. So we can see now we have this fall. So basically, where's the last swing high that was created? This is the last swing high point. So basically now we'll be looking forward to see if price is returning to the upside. Price should seek this swing high point, which is the buy side liquidity, because now price created this high points. We had the impulse to the downside that broke this swing low points. So you can see also from the daily time frame, you can see we're having structures within that. But then when we go to a higher time frame like the weekly, you're going to see you just have an impulsive movement. So are you seeing here in the weekly, we just have an impulsive movement to the downside. So you can see how when you're going to higher time frame, it helps you reduce the noise. So you can see how here is just an impulsive movement. But then back to the daily time frame. So we can see now, want to see the return of price. Price should seek the internal range liquidity before we have the continuation, because we can see price broke through the swing low point, took out the external liquidity. And when you're looking forward to your inducement liquidity in a bearish market condition, the point of interest you want to identify are basically the point of interest above the inducement liquidity. And clearly what you can see, I told you that the internal range liquidity are the swing high points or low points depending on the market condition, and also the fair value gaps. So what you can see clearly here is we have this swing high, we also have this fair value gap. Let me identify that for you to see. Above that we have this fair value gap. So basically between this candle low points and this swing high points, you can see we have a fair value gap. So we have a fair value gap there, which is also an internal range liquidity. Fair value gaps also act as sponsorship zones. They act as point of interest. You can see at times when you're analyzing the charts, you would see that price doesn't return to an order block. The price just returns to a fair value gap, and then you have price movement to the downside. So basically, when you're trading, there are order blocks, there are breaker blocks, there are mitigation blocks, there are rejection blocks, there are fair value gaps. All these are sponsorship zones that price has a tendency to react at any of them. It mustn't just be the order blocks. So clearly now what you can see is above the buy side liquidity, which is our inducement, you can see we have this fair value gap. So basically now what you can see here, we are in a bearish condition, right? We're moving to the downside. Now, basically, this means we're having down close candles. Down close candles. You know, the bearish candle opens at the high and then close at the bottom. It opens at the top and then close at the low. So, bullish candle opens at the low, close at the high points. So basically, when we talk about order blocks are basically the candles where the institutions manipulate the movement of price, where they fix their orders. So basically, now what you can see in a bearish market condition, we are supposed to have down close candles. Now, what you can see here is the institution sponsored more bearish movement. We had a down close candle, but within this bullish candle is where the institutions manipulated the price, giving us the thought that this is going to be a bullish market movement. Because you can see here we have what? An up close candle. This is the open price. This is the close price. Basically, what I'm trying to say is this. For the bullish candle, we have the open price. Price will trade a little bit higher, create a low point, and then we have the push to this, and then we have the close. This is it. Here we have the open price of that candle. This is the open price. And then price will trade to the downside to create the low, which is basically this point here. So price will create that low point, which is this. And then we have the push to the upside. Now price would return to the downside and give us the close. This is the close. This is the close of that candle after price creates the high. So basically we have the open price. Price will trade down to create the low of the day, which is going to be the candle wick. And then we have the bullish movement that is going to create the candle high. And then we have the return to give us the close price. So the bullish candle opens at the low and closes at the high. That is how the bullish candle is being delivered. The bearish candle opens at the high and then closes at the low. So basically now, from this bearish movement you're seeing to the downside, you need to ask yourself, where is the last up close candle that sponsored the bearish movement that took out this low point? Basically, what you can see, this is the last up close candle, because this is where the institutions manipulated the price to make us think that the market is going to be in a bullish move. Because we are having down close candles. Here we had another up close candle. You can see when price fell to the downside, it returned to retest that. Price fell with this impulse to the downside, created this last bearish candle. Now we had a movement of price to the upside. We had the close of price at the low, but within this candle gave us a higher price, because the institutions will always want to sell at premium and they want to buy at discounts. So what we can see is this is the last up close candle before the impulsive bearish movement that broke structure. So basically now we have the fair value gap here and we have the bearish order block. So you can see we've identified the sponsorship zones above the liquidity, the inducement liquidity. So we can see the possibility of price returning to mitigate the fair value gap, and we have the fall of price, or price could further return to mitigate the bearish order block, and we have the fall. Because clearly what you can see here also, this is a flip zone, because here we have the bullish movement, because here we have the bullish order block. This is the last down close candle before the bullish movement. And now price came here and created the up close candle before the bearish movement, meaning this bullish order block created a bearish order block within its zone and sponsored an impulsive movement. So basically this is a strong zone that we can look forward to see price react at, because we can also see the fair value gap. So let's play price to see, because we are just basically marking out structures. I'm not teaching the point of interest, area of interest identification. Once we understand structure, then we'll make progress. So let's play price to see what happens. Now we can clearly see now price return to the fair value gap. took out this inducement liquidity. So you can see price from this high took out the external range liquidity. Now all we have is a valid low point. Price have created this low because we can see this sponsored the movement that took out the internal liquidity for the field of this fair value gap. So let's see if price is going to continue to the downside to take out this newly created low points. So let's play price to see. Awesome. Now we can see price further went back into the last up close candle that sponsored the bearish movement that broke structure. Let's see. Okay. Now we have a break of structure to the downside. The institutions have broken the structure, and so basically now we're seeing how we can identify our structures. So we have the break of structure, meaning this is our low and price have created the lower high points. So we have our lower high points here, and we have this break of structure to the downside. So clearly our expectation now is to look forward to see where are we going to actually see and identify our inducement liquidity so that we can continue bearish to the downside. Basically, the internal range liquidity that the institutions would want to seek, because now these high points have taken out the external range liquidity and give us a valid break of structure, because you can clearly see that volume here closed below this low points. But what you can see first is we have price swept the low point. This candle here, the bullish colored candle, swept liquidity and gave a bullish move before giving us a valid break of structure. Volume was closed below a previous swing point to validate that break of structure. So this is not the candlestick that validates this break of structure. It is this bearish colored candle that validates the break of the swing low points, giving us a valid break of structure. So what we can now see is when we are identifying the structure within the impulsive leg movement, it basically means we have from this high to this candle low, and now we have a pullback. And now what we can see is price falling further to the downside because we can't really find any pullback within this bearish candles. But when you drop to a lower time frame, you're going to still find more internal structures within this bearish movement. Let's check the 4-hour time frame. So you can see within the 4-hour time frame, you can see you can find more pullbacks. Basically, you see we have the fall to the downside. Price gave this pullback. Price fell, a pullback. Price fell. You can see here we have a pullback here, and now price fell. So it means that from the 4-hour time frame, you have an inducement liquidity here. What we must understand is there are times that institutions will take out the inducement liquidity in the lower time frame and then they will continue bearish or bullish, but then they can still also return and take out the higher time frame inducement liquidity. Let's go back to the daily. You can see here in the daily we don't really have a pullback within this bearish movement to the downside. Let's check that. I'm coming. Let's see. Now we had this bearish movement. Okay, what you can clearly see is this. You can see this candle wick to the upside took out this previous candle high point. So you can see this candle wick took out this previous bearish candle high. So you can see from the daily time frame, you can't really see the pullback within this movement. But you see from the 4-hour, we identify that pullback. So basically, we have an inducement liquidity zone here based on the structure that the 4-hour gave us. So we can see, let's just play price to see how price delivers to the downside. So what I'm just trying to say is in establishing structure, you must find out and identify external, internal range liquidities. So what you can now see, we had the price movement to the downside. This is the lowest candle, and we can see a return to the upside that swept the high of that candle. So this is a pullback, and now price further fell to the downside. So now from the daily time frame, this is where you have the inducement liquidity, because that is the most recent pullback after the break of the structure. So when price is returning to the upside, basically you'll be looking forward to see that the institutions will read the swing high points. And clearly you can see that we have the bearish order block. We have this up close candle before the bearish movement to the downside. You are in a bearish movement. What you're seeing are down close candles, down close candles, down close candles. But then the institution sponsored an up close candle before continuing bearish to the downside. So we have the bearish order block here. But since what you can see, you can't mark out this bearish order block as a zone to want to consider executing your sell entry from. Why? Because this is the first pullback after this break of structure. So there is the high probability that this would take out these high points, will raise the liquidity. Basically, the stop orders resting at the high of this order block, and then we have the bearish continuation. So this means this is our most recent inducement liquidity to the downside. So we're looking forward if the market is pushing to the upside. This is the draw on liquidity. Let's play price to see. Okay, let's see. All right. So what you can see now is we had the sweep of that high points. Price is respecting this bearish order block, but you can see the institution sponsored a manipulation above it a little. And then basically this means there was a sweep upwards. Stop losses resting above the high of the bearish order block. Because we already know, we're taught to trade at such sponsorship zones. The institutions at times know what we are trading. The algorithm knows where the stop orders are resting, the liquidity, so we can see price went above to take out any form of stop losses resting here. So let's see if price is going to continue bearish to the downside. Then we can validate the structure. Let's see what happens. Okay, wow, this is a poor price. So what we can see here, you can see clearly now, the price is accumulating. We're having a consolidation here. We're just having price moving within this range, basically facing resistance, and we're having it facing a support level here. So price is just ranging. So basically now, since what you're seeing here is a ranging price condition, which is an accumulation. So based on the power of three, most times when you're in a bearish market condition and price is accumulating, you see that price is accumulating and you're in a bearish market condition, what you want to expect to do is to actually sell from the high here, from this relatively high point, because the institutions will seek the buy side liquidity before continuing bearish to the downside. What we have here are what relatively equal high points. All these are liquidity pools that the institutions will create. So we have this liquidity pool here, relatively equal high points, and you also have the relatively equal low points resting here, sell side liquidity. So if you're in a bearish market condition, you want to see the manipulation to the upside so that you can have the bearish continuation, meaning the institutions will seek the buy side liquidity, mitigate a sponsorship zone above the buy side liquidity. It could be your order block, it could be your fair value gap. Mitigate that sponsorship zone, and then you have the bearish continuation to the downside. So whenever you see accumulation and you're in a bearish market condition, look forward to the sponsorship zone above the relatively equal high points. Look forward to an order block or fair value gap above those relatively equal high points. And then that is where you want to frame your sell move from. So let's basically watch and see how this unfolds to the downside. We've clearly seen this is the accumulation. Let's play price to see. And sorry, I think above the accumulation, what we can see is we have this fair value gap above the accumulation. We have this fair value gap. We also have another fair value gap above here. We have this fair value gap. And here we have the inducement liquidity from the 4-hour time frame. But anyway, price took out the valid one from the daily. But since we've seen price accumulating, we could see a push to the upside, either to this zone, and then we have the bearish continuation. So let's play price to see. Okay, so now we can see price traded above, took out the accumulation phase. Price even went quite above this fair value gap to also take out that first inducement liquidity we identified from the 4-hour time frame. Now price took out all this internal range liquidities, filled up the fair value gap. Let's see if this is going to continue bearish to the downside. Okay, now let's do it with this so that we reduce what's on the chart. Okay, so we can see how price fell to the downside, went back, took out the inducement liquidity, filled up this fair value gap. Now the impulse to the downside. Price took out this low points. We have a value break of structure here. We have that break of structure, meaning what we clearly have here is a valid low point, and price gave us the high points because this sponsored the impulsive movement to the downside that broke the structure. So now what we have to do is within this price movement, we want to frame out the structure within it, the internal structure within the impulsive line movement. And what you can clearly see is you can't really find a valid pullback within this impulsive movement to the downside. We have the fall to the downside. This is the lowest candle, but you can see that the bullish candle did not trade to the upside to take out these high points. So it is not really a valid pullback. So in such market condition, when I don't see an internal pullbacks, I identify the fair value gaps as the draw on liquidity that the institutions want to seek to mitigate before we have the bearish continuation. But what we can see here is price have even gone above this fair value gap. So basically what you need to look at the extreme, what do you have? You have the bearish order block because this is the up close candle before the bearish movement to the downside that broke this low points. So we don't really have internal range liquidity in the form of swing high points. We only have this fair value gap. And we can see that price went above that. Now price is reacting at the bearish order block. So let's see if price is going to respect this and give us the bearish movements. Let's just see what happens. Okay. Whoa. Now we can see that price further went to the upside and took out this high. So you see the institutions would move the markets. The algorithm will move however it wants. The fact that we have structured information doesn't mean that we would always win in trading. But this structured information helps us to take proper trade entries and also to minimize our risks. So now what you can see is price went above our valid swing high points and then raided the high. We can see this candle wicks took out the high here. So this affects our structure. So what you can see is we have this swept this high. Basically now our structure has been affected because this now created the most recent lower high points because this swept this high points. Let's play price to see if we're going to have the continuation to the downside so that we know we're establishing still a bearish movement. Okay, all right. So price now went further to the downside and broke the swing low points. We have the break of the swing low points. So basically now what this is meaning is this is not the inducement now based on how price have delivered, and this is not the high points. This is now the high points that price created. This is the lower high points. This is the lower high points, and it is this swing high points that acts as the inducement liquidity because price went to raid that. So you can see that is why I would always say this. The fact that we have structured information doesn't mean it will always play out just the way we've been taught or just the way we see textbooks examples. So what we can now see is it means this is the impulse to the downside. This is the deeper pullback. Price fell. Now we see price gave the movement and took the swing high, took out this buy side liquidity. So it means this is our impulse and then this is the pullback. This is what I'm trying to mean. It means this is the impulse to the downside. This is the pullback. And now we're having this impulse again to the downside. Now, meaning this is our new lower high points and this is our lower low points. So let's identify that. So we have this is our new structural points. That's our new structural points. So we are still maintaining the bearish movement, even though we can see a manipulation that took place here and took out that high points. We have this break of structure here to the downside. Let's see how we can identify the structures within this impulsive movement. What we can see, we have from this high point to this low, we have a valid pullback here. And now what we can see again is this is a low, but this is not a valid pullback. So we have price falling to the downside. If we're looking at where's the buy side liquidity, that if the institutions are returning to the upside, they would want to seek before continuing bearish. This is that buy side liquidity. But this is really at the extreme. So we may not really see that bullish movement, to the upside to rate this. So let's display price to see. Okay. Now, what we can now see is price fell to the downside. We have this pullback. But what you can see is this movement did not sponsor strong bearish movement to take out this low point. But what you can clearly see is that it still created a high point. We can see the fall of price to the downside, this pullback. But then this failed to continue bearish. Price further went back. So you should know price is seeking internal liquidity. And where's that internal liquidity? It is this high point here. Price took out that liquidity. The institutions would always seek liquidity. So let's pay price to see what happens. Okay. Now, what again we can see is, let's identify what we're seeing here. Price gave this movement. I want you to clear. So we have the movement to the upside. Price fell, gave another movement, took out this liquidity, but then price fell, failed to continue to the downside. Price went again further back to the upside. So you can see price is just seeking internal liquidities. It is just seeking the high points, taking out all forms of stop losses resting above the swing high points. And you can clearly see that this also looks like an accumulation because you can see it ranging. It's a consolidated market. It's not really trending. So this is also an accumulation. And now you can see, I believe this is our established manipulation. Because what you can see now is, where is the last up close candle before the bearish movement that broke this previous swing low point? Here we have that last up close candle. And now price fell. Though we can see that price did not really mitigate the body, So, there are moments you can miss a trade, not because you are wrong, but because that trade did not reach your entry level. So you can see this is the up close candle, the volume here, the low. You can see this is the up close candle before the bearish movement that took out the swing low. Now you can see this did not really mitigate that, but we can see bearish movement. So basically now you can see prices taking out internal liquidities. What we have here is an accumulation. Now we have manipulation. So we're expecting the distribution to the downside. So let's do away with this. So let's see how price delivers to the downside to validate if price is going to break this low, and we have a valid break of structure. Okay. All right. So what we can now see is price broke the newly created low points. Our structure has been established. This is our newly created low points, and this is the high points. Now we have the impulse to the downside. Now what you can see here is this candle swept this low. This is not the candle that gave us the valid break of structure. What gave us the valid break of structure is actually this candle here. This bearish candle gave us the valid break of structure, because this is where we have volume closing below the wick of this bearish candle that swept liquidity, and also closing below the swing low points we have here. So this is not the candle that validates the break of structure. This only swept the previous swing low point. This is the bearish candle that validates our break of structure, because you can see volume close below the wick of the candle that swept this swing low, and also this volume further close below this low point. So it means that our break of structure, which is swing low point, the break of this low point is validated by this bearish candle. This bearish candle is what validates the break of that swing low points. Let's look at the internal structures within this. Basically, what we have is we have the impulse to the downside, we have the pullback, price fell here to the downside because this candle now swept the low here, and now we can see this return took out this high. Price fell, price gave us this movement. Now we're seeing bearish continuation to the downside. Let's play price to see how this delivers. Let's see. Okay, so basically what you can clearly now see is price gave us another pullback here. So if we're seeing price trading to the upside, meaning this is the draw on liquidity, this is the buy side liquidity, we're looking forward to see how the institutions will take out that inducement liquidity. So basically what you need to find above the inducement liquidity is a sponsorship zone that price has the probability of returning to mitigate. So clearly what we can see here, we have the extreme bearish order block. So we have that extreme bearish order block above, and what you can see now is above here again, we still have this rejection block, and we have it as the institutional order flow here. Let's mark this out. So we have this institutional order flow zone, or you could just refine that to the rejection block here. So you can see this is the last buy movement before the sell movement to the downside. Where is the most recent impulsive movement? That is what you must also pay attention to. This is the most recent impulsive movement. Where is the zone? Where are the candles that sponsor the most recent impulsive movements? These bullish candles, they sponsored the what? Impulsive movements. And what you can clearly see is that this candle took out the liquidity of this other candle that swept the low. You see, this candle took out the external range liquidity, swept it, but now price return took out the high, swept it, swept the high of the candle that swept the low. So we can see this zone took out buy side liquidity and further validated our break of structure, because it is this candle volume that validates the break of the swing low points. So clearly now you can see we've identified the zones above the inducement liquidity. So we have, this is the first zone and this is the extreme. This is the extreme. So if this is still within equilibrium or premium, price has the high probability of respecting this and not necessarily returning to the extreme, because clearly now we can also see this took out buy side liquidity and sponsored the impulsive movement. This is where we have the most recent impulsive movement. This is an institutional sponsored movement. We retail traders, we don't have that huge volume to actually give impulsive movement in the market. The institutions sponsor those movements. So this is where we have the most recent institutional movements to the downside. So let's see what happens. Okay. All right, price is mitigating that. Okay. Oh, we're having, okay. All right. So what you can now see is price took out this low points, giving us a break of structure to the downside. So we have our break of structure. So basically it means our structure has been validated again. We have price that created the most recent low, and now we have the lower high points. So you can see we're clearly identifying our structures. Once you understand how to mark out valid structures, understanding your point of interest becomes easier to identify. So we can clearly see now we have, this is the low points, and now we have the impulse and the fall. So when you go, let's check the weekly time frame. I just want you to be having a clear picture to this. You can see here in the weekly time frame, it is just an impulsive movement to the downside. So the higher time frame help reduce the noise. Okay, let's look at something here. So you can see now from the weekly time frame, you can clearly see how you want to identify that. You can see four, the pullback. You can see the four, the pullback. You can see you have the four here, the pullback. You can see the four, the pullback. You can see the four, the pullback. You can see now the most recent four. So you can see this reduces the noise in the chart. So let's get back to the daily. Price have broken the swing low points. So basically, where's the most recent pullback? Basically, it's this high point because this is the pullback before the breakout structure, before price took out the external liquidity. So if price is returning to the upside, then price may seek this as the draw on liquidity, the buy side liquidity, before continuing bearish. But let's split price to see if price is going to create an inducement to liquidity, a new swing high point. Let's split price to see what happens. Okay, now I think, let me see. Okay, sorry, let me clearly see this. All right, you can see this is the lowest candle, and then here we had this pullback to the upside, and price fell again and swept here. It means what I'm saying is, let's just take that from here. We had this fall, price went above this, took out this high points. Now we have this fall. So basically, it means we have our identified inducement liquidity here. Though this is quite too low, but it's still a buy side liquidity. And above that, what we can see, we have this fair value gap. We have this fair value gap here. We also have this fair value gap, all internal range liquidities. We can see how price return to that. So we have this fair value gap, we have this fair value gap. And basically, where is the last up close candle before the bearish movement that took out this low point? This is that bearish order block. This is the last up close candle before the bearish movement. So we have this. We also have this point of interest, and we have the extreme. So since this now acted within the flip zone, where we have price created this before breaking structure, price may react at the fair value gap or retest this up close candle. This is the where the manipulation movement took place. This is where institution bought to sell, meaning they give us a higher price and then they dumped the price to the downside. This is where the manipulation took place. So let's do it with this. Let's pick price to see. Okay. All right. Okay. All right. Okay. Price. Now you can also see again here. Let's do it with this so that the chart will be clear, please. Now you can see we have another accumulation phase here. We have another accumulation here. So when we are in an accumulation state and you're in a bearish market condition, you should look to buy above the accumulation. So you can see price took out this inducement liquidity, but then when price traded further to the upside, price created this accumulation. We have this consolidation. And now you can see price gave us this manipulative movement because this is just a forced breakout to manipulate people to expect bullish momentum. So price gave the accumulation manipulation, and now we can see the fall of price to the downside. Let's see if price took out the low points. Then we begin to validate structure. Let's see. Okay, yeah, volume closed below that. So we have a valid breakout structure there. So we have a valid breakout structure. So this basically means that we've established our swing points. And clearly what you can see here is this is the swing low points and price has created the swing high points. So we're going to have to now see that this is the lower high and price fell. You know, some people who don't really understand how to identify structure will look at this as a pullback, and if price should break this high points, they'll look at it as a market structure shift, a change in character. But no, this is not the high point. This is the high, because this is where the high is created. This is what sponsored the break of this low point. It means This is basically how we identify structure. You have fall, the pullback, fall, the pullback, the fall. This is the high. This is the valid high points that led to the break of this low points. So what you can see is when you have a movement like this from this high, you have a pullback within that, and then you have a fall. This is not the lower high. This is the lower high. This is just a structure created within this range. What we can now see is price gave us our low points, created the higher low. So we have the fall to the downside. Let's see. Let's play price to see. Okay. Okay. All right. So what you can clearly see here, we have this fall, we have this pullback, we have this fall, we have this pullback, we have this fall. So basically now we can see this is our inducement liquidity. This is the internal range liquidity, the buy side liquidity that the institutions would seek to raid, internal liquidity, before we continue bearish. And what you can see is here's where we have the fair value gap, and we have this up close candles before the bearish movement that broke structure. Meaning this is our point of interest, this up close candles before the bearish movement that broke structure. This is where we have the most recent impulsive movement. So where is the buy move that sponsored that impulsive movement? These candles, though the volumes are quite low. And then now we have the extreme point of interest here. You can just consider this up close candle. Now we can see price reacted at this, filled up this value gaps, reacted at this. Let's see if that continues bearish to the downside. Okay, so clearly now what we can now see is we have a break of structure here. We have price created the low points. This is the swing low, and this is the high points. So now we can see that we have another structure established, lower high points here. Price dropped to the downside. We have the break of structure. The inducement liquidity have been taken out. Price took out external, created this low, return, seeked the internal, mitigated the institutional sponsorship zone that gave us this impulsive movement that broke structure to the downside. And now we have the bearish fall to the downside. If we're looking forward now to where institutions may return to seek liquidity, basically we have that here. We have this impulse here. This is the lowest low. And now we had this pullback because this swept the high of the candle that printed the low points. And now what we can see, we're having the fall. So basically, we're looking forward to this inducement liquidity. Price may return to mitigate this bearish order block, because what we can see is the main threshold of this is not yet mitigated. Even if we can see this return, there's a probability that price will respect this and continue bearish to the downside after seeking these internal liquidities. And you can see we have this fair value gaps. So let's play price to see what happens. Okay, okay, okay. Now what we can see is price return to the upside, did not seek this liquidity. Price created these high points, fell to the downside, but failed to take out this low. Let's identify that low. Let's identify that low. So price failed to take out that low point. And now we're seeing price pushing to the upside. We do not really yet have a market structure shift until price takes out the high points, because this is the valid high points. This is our range from this high to this low point. So the movement we are seeing here is still within our valid structural range, because this is the high and this is the low. So we see price return, reacted at this, filled up this fair value gaps, fell to the downside, failed to take out this low. Price now is trading back to the upside. And where we can see price returning to now is price is returning to the sponsorship zone at the extreme. the bearish order block. So our expectation is to see if price is going to continue bearish, then it should respect this and fall to the downside. So let's play price to see what happens. Okay. Wow, awesome. So we can see how price returned to the extreme, the point of interest, gave a reaction to the downside, but then price failed to continue bearish to the downside to take out this low points. You're clearly seeing that, right? Okay. So price failed to continue bearish to the downside to take out the low points. And what we can now see is price gave us impulse to the upside. We had this impulsive movement. So let's go over with the bearish order block annotation. And we can clearly see what happened here is price broke our valid high points, leading to now what we call the market structure shift. So you can see now we're now having the tendency to see a reversal in the market, because basically what you can clearly see from the chart is that now we have a market structure shift. We're not having price continuing bearish to the downside. We're no longer really in a bearish market movement. We're now having the tendency to be in a bullish market condition. So let's play price to see how this unfolds. So, okay, now what we can clearly see is we have price moving to the upside. Now, basically, if we're looking for a return to the downside, then we want to see the institutions seek liquidity. We can see we have this low points, price created. All right. You want to rest? Okay. All right then. All right then. No problem. I'll send the record to you then.